From New York City for our viewers worldwide, I'm Manus, Cranny. Bloomberg Real Yield starts right now. Coming up, markets close out a volatile week that sent yields on a wild ride. Investors placing their bets on what the Fed will do next. And high-grade U.S. issuance passes $1 trillion for 2024. We begin with a big issue, closing out a week of chaos.
It's a market which is on edge.
Yes, we've seen volatility.
Market volatility over the last week.
More volatility than we would have expected.
This is an overreaction, but I don't know when that overreaction stops.
We're obviously slowing down.
The U.S. economy, it's slowing, but we're not heading towards recession.
There's a higher risk of recession than zero, but it's still not a base case.
Moderate slowing and this increase in the unemployment rate has been in the past consistent with early in recession.
We're either in a recession or about to confront one.
The Fed needs to regain control of the economy.
The Fed's going to have to react a little more aggressively as we move through the next couple of quarters.
50 basis points in September is really just getting started.
And I don't think that we're yet at the point where the Fed's going to have to start cutting 50 basis points.
The markets have really jumped on this bandwagon of U.S. recession, dovish Fed. And it's going to take a while to sort of unwind those expectations.
We're probably going to be in a bit of a volatility storm here for a while.
What markets are grappling with is how does the Fed calibrate its response mechanism? What you have here is twos, tens. There was a very seminal moment. It was on Monday when the twos, tens disinverted. You have been inverted for the longest time on record. This disinversion was a flashing narrative to the market, which said growth scare, Fed behind the curve, needs to pull up their boots, do more and do more quickly and do it quite fast. That moment passed as the market began to quell itself. You had the Bank of Japan verbal put, but really no intonation in terms of where the Fed would go. They still want time. This was about growth scare, and this is about the Bank of Japan soothing the risk nerves as they gave air cover to unwind the rest of your carry trade. Roll it forward and you begin to understand the kind of parabolic moves in the rate market. At one juncture, post-jobs and post-Monday, when we saw that massive unearthing of the carry trade, the market suggested 150 basis points. Let's roll it forward. 150 basis points at one juncture, a 60% probability of that. That has dissipated and calmed through the week. Then there were the calls for an inter-Fed meeting cut. That seems to have subsided as well, and we're back to 4. Are 4 rate cuts enough to put a floor in the economy and the correct response mechanism to a slowing economy? To understand the calibration of the slowdown, that comes to what people think is really going on. Goldman Sachs CEO David Solomon caught up with the Bloomberg team, and he gave us his outlook for rate cuts.
I don't expect that you'll see anything before September. We do have a long period now. We've got 40 days until the next Fed meeting. Which actually I think is a reasonable period of time for the market to digest more of the news. I'd say the market expectation is certainly for cuts in the fall. I've been more cautious around interest rate cuts all year. As you remember, the market expectation early in the year was for 6 or 7 cuts. Based on the economic data we're seeing now and the messaging from the Fed, I think it's likely that we'll see a cut or two in the fall. But I think you've still got to wait and see as things unfold. And the economic trajectory over the next couple of months and additional economic data will certainly have an impact on that.
We have 40 days to recalibrate and to understand the response mechanism. Jay Barry of JPMorgan and Jamie Patton of TCW are my guests this morning. I'm curious to know, I haven't seen that kind of vicious moves in bond markets for decades. Jamie, good morning, good afternoon to you. So, after a week of reflection, a turnaround of 33 basis points in the 10s, what is the bond market saying to you right now?
Even after these crazy moves, the bond market is still telling a story of this perfect soft landing where the Fed is easing because they can. There's about 100 basis points of eases priced in for this year and another 100 for next year. Even this time next year, we're still at around 3.5% compared to the Fed's own definition of neutral, which is their long-term dot at 2.5%. Rates are still restrictive. And even 2 years from now, the trough of the Fed funds curve is still 3%. So what the market's telling you is the Fed did such an amazing job that inflation has come down. Rates will never even really need to get to neutral, let alone accommodative. And we at TCW couldn't disagree more with that narrative, and that's why we're long duration. We think the Fed is going to be easing because they have to, because the economy is weakening, lags are longer, we still haven't even hit markets and the economy with the full effect of that rate hike. So we have a ways to go. And on top of that, lags are going to be long on the way down too. So the Fed easing rates a quick 100 basis points isn't really going to help the market that much if it doesn't feel it for quite some time after the move.
Okay, so you're long duration and you're happy with that position. A number of people are saying, look, on the backup of yields, you want to pick up and reload duration. It mightn't be as rich, but you want to take it on board. That's PIMCO. Good afternoon, JPMorgan. Jay, how are you doing? Now, listen, you're going for 50-50 back-to-back cuts, and I checked it with you in the break. I was quite surprised. That is a bold call. 100 basis points within such a short space of time says harder landing than we currently think, to me.
Hey, Manus, and thanks for having me on this afternoon. So I think our call is, not too different from Jamie's, but I think there's some nuance to it, that we are looking for aggressive eases in both September and November. But I think it's because there's been a constellation of weakness in the labor market data that we've seen for the last couple of weeks, which was punctuated with employment last week. But also because the Fed says now that it's attentive to both sides of its dual mandate and not just the inflation mandate. So from that perspective, given what we've seen in labor markets and given what the Fed has told us, we think this makes the case for the Fed to get back to neutral with haste. Because as Jamie said, there are long and variable lags to monetary policy. It's evident that policy is restrictive right now, and we think this means the Fed needs to get to a less restrictive place and with some relative haste. So we're not necessarily in the hard landing camp. We just think the case for policy to remain restrictive here is losing steam rather quickly, and we think the funds rate will be back at 3% by the middle of next year.
Okay, so 3% by the middle of next year. Let's just get a very rapid response from both of you. Jamie, from you, first of all, you're long duration, but on this whip around in yields, I mean, 30 basis points on the 10s, we traded back above 4%, etc. Do you relock and reload? Do you get the sense that there is dry powder out there that perhaps missed that first shock wave on the downside and is ready to redeploy into duration?
Absolutely, and we remain long. Nothing about this week's price action made us change our mind that the right move is long duration and especially concentrated in the front end as the yield curve normalizes.
And Jay, for you, again, not just long duration. I know you both like steepeners, but again, the concurrence for you, is this a re-enter, relock, reload?
Yeah, so we've been sitting neutral on duration, Manus, but I think we're receptive to what Jamie said here. We'd like to use any further backup to add duration on an outright basis. The challenge has been in this inverted yield curve environment that being long duration is a negative carry trade, and we have felt much more comfortable with the steepener and the long end steepener as a reflection of our strategically bullish view, simply because it is less punitive from a carry perspective, and it tends to outperform in the period heading into the first cut. My lone reservation over the very near term, and we saw it this week, is that both long duration Treasury auctions tailed and came with relatively weak end user demand, which tells me that perhaps this demand is somewhat exhausted here. And we've also seen a pretty strong buildup of dealer inventory in Treasuries. It's now very close to record levels. And this makes sense in a world in which we're transitioning away from price insensitive demand towards price sensitive. But I think we can just be a bit more patient before adding duration. But I would certainly agree that the path is towards lower yields, particularly as the front end, particularly as the Fed begins to ease next month.
Jamie, different people have said to me, oh, it's just lousy demand on these auctions. Stop exaggerating it. Stop exaggerating the tail. I like a little bit of drama in markets. But is it just a small waving flag rather than a vicious red flag for you on those two backup in those auctions, Jamie?
I also like drama. I love Bravo. But in this case, I'm going to have to make you guys feel a little bit better because we think that was just kind of a blip in volatile markets. An example would be in July, we got the stripping data telling us how much demand there is for long end duration, and that was an all-time record high. So we had a couple auctions that came a little bit cheap to the market. That doesn't tell us a fundamental or technical signal, the same as stripping data, which is real buying. So I think what happened in the auctions is that amid all of that volatility, a lot of the strategic auction strategies where people short that day and cover in the auction and just try to make a couple basis points, those guys just said, you know what, there's too much going on for me to play that game. So I'll just pull out of that. I think that's why you saw dealers end up with a lot of it. So we don't take much signal from that. We do take a lot of signal from demand for long duration via stripping activity.
And let's just close it off with you, Jay. We saw former President Donald Trump saying that he would like to have a little bit more say over interest rates. Let's just take a very quick listen and we'll get your response.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
The Bank of Japan learned what it is to have politicians push them along the way. This last couple of weeks, Jay, to you very quickly, do you think that's just bluster, or is that a real challenge to U.S. exceptionalism if it was ever to come to pass, and true interference from the president, if he becomes the president?
So I think, to be clear, Manus, I think the Fed has benefited from being an independent institution, and its independence and the independence of other developed market central banks have been very helpful in attaining 2% inflation over time. And if there was a perception that the Fed was to be less independent, I think inflation expectations, which have been very well anchored here, very close to 2%, would be at risk of rising. And that would mean that there would be the risk that long-term yields could climb on the back of that as markets perceive the Fed to be less independent and less attentive to both sides of its mandate. So I do think its independence is a strong positive for the Fed, and any change to that could put inflation expectations at risk.
Okay, Bond team, thank you very much for joining me on Real Yield. That's Jay Barry of JPMorgan, Jamie Patton at TCW. Up next, we've touched on the auctions, but we'll run you through. Credit issuance this week gets halted amid all the vol, only to restart again when its biggest day of the year came from Meta. They led the pace. We talk credit on Real Yield right here on Bloomberg. I'm Manus, Cranny. This is Bloomberg Real Yield. Time now for your auction block. Where did the bond sales come from this week? Well, we were caught in the middle of a hugely volatile week. Treasuries had auctions of 3s, 10s and 30s. Of note was the 10-year sale, the lowest yield since July 2023. The 30-year auction, that tailed and spooked a few people. Primary dealer, that was awarded at the highest level since last November. Over to the credit markets, global turbulence from early in the week that halted high-grade U.S. issuance, but by the middle of the week, it was the comeback kid with a vengeance. Meta led the way with $10.5 billion sale, helping to push the 2024 total over the $1 trillion mark. And that hit that level at the fastest pace since 2020. The U.S. high-yield sales came in to almost complete halt this week until we saw a late week flurry, and that came as risk premium on junk-rated bonds spiked to the highest level since November. Ashok Bhatia over at Neuberger Berman, who sees opportunities in credit.
This has created some opportunities in high-quality double Bs, in some of the longer duration triple Bs, where names are 25 to 50 wider. Now, I think, yield credit spreads are still pretty low in the grand scheme of things, but there's definitely a little bit more opportunity. And we do think that, if one of the big things that comes out of this is the Fed wants to get to its neutral rate faster, and this will all be an excuse for the Fed to do so, that should actually be a bit more supportive for credit and take out some of the tail risk.
The road to neutral can be paved with good intentions. Joining me now to discuss the credit markets, Matt Mish, head of credit strategy over at UBS, and Maureen O'Connor, global head of high-grade debt syndicate at Wells Fargo. Thank you so much for both being with me. Maureen, let's start with you. I've described this week as being pernicious, and there really was a pernicious repricing of bonds, of risk. There was a reaction, and a visceral reaction, in the spreads, high yield and IG. We popped, but we didn't blow. I would say we were disrupted, but nothing broke to me. How did it look to you?
Yeah, well, I think what was clear to me from the price action and investment grade this week is that investors were ready and waiting for this correction. If you think about sentiment through the whole first half of the year, we were sitting at near 2-year tights in spreads. Valuations were ultra tight. No one really saw value. Really, the overarching sentiment was spreads were underpricing the risk in the overarching economy. We were waiting for this backup. Investors spoke in a very big way in the primary calendar. We shut down really for only one day on Monday, and had a $54 billion week of supply. So we've come back quite quickly. Spreads have recovered, probably half, maybe 3/4 of the widening that we've seen. I'm not sure we're heading back to 2-year tights anytime soon, but we're definitely at a place where investors see a more advantageous entry point.
So, Matt, we're at a moment of repricing, really, here. A moment of realization that perhaps the halcyon days of tight spreads needs to be reviewed.
Yeah, certainly, this volatility shock, I think, certainly has woke up some investors, right? It's been a very range-bound market this year. I would say three things under the hood, though. The first is, credit has definitely outperformed other asset classes. So high yield spreads widened from about 310 to 380. That's about a 1 sigma move over a month. If you look at U.S. Treasuries, that move in tens was about 2 sigma. If you look at the VIX index or dollar yen, those moves were 4 to 5 sigma. So the first main point is that credit really did outperform despite the quote unquote pop. The second I would underscore is that a lot of the systemic concerns, so clients have the concern mainly what's next, right? Or what breaks next. And I think in that context, we took a lot of confidence in the fact that US and European financial spreads, so that's bank and non-bank spreads, really outperformed or market performed in this sell-off. And the last point to keep in mind is, that high yield spread today is probably back down at 340. So at least in high yield, we've retraced over half the move. High grade spreads are lagging, but I think that high yield barometer is important because that's the market that is most sensitive to economic activity and to the discussions earlier today about growth and are we really heading toward a potential hard landing.
And Maureen, this plays, to your part of the world, which is the debate. If I look at the rates market had a 60% probability of a 150 basis point cut and an inter-meeting cut. That high yield market convulsed, as you said, but what kind of landing are you now thinking about? We had something on Monday, but the world has recalibrated in the past 5 days. How do you think high yield has recalibrated?
Well, my expertise is really in the investment grade market, but I can tell, just from a credit perspective more broadly, the market has to be a little bit careful about how it plays out the next few weeks in the lead up to this first live Fed meeting. Obviously, the market is pricing in some pretty aggressive moves from the Fed, and anything short of a 50 basis point cut in September, I think, is going to take the market by surprise, and we could see rates heading back higher again. Obviously, we've retraded a lot of the rally that we've seen for this past week. That will ultimately drag on returns in the asset class. That could incite some outflows. Inflows have been pretty strong up to this point, so it's hard to believe that paradigm is going to shift entirely, but we are watching that carefully. And from a borrower's perspective, where I advise clients, the coupon opportunity here is fleeting, right? We've had a moment in time where rates rallied pretty strong. Spreads obviously corrected in sympathy, but not in a one-for-one basis. And there was an opportunity to de-risk your funding plans at lower levels than what we've seen all year from a fixed coupon perspective. Obviously, that has shifted as rates have sold off, and any rate risk higher, again, if the Fed decides it's only a 25 basis point move, or the messaging out of Jackson Hole or whatever starts to lean a little bit more hawkish, I think we're at risk of seeing that opportunity pass us pretty quickly here.
So you need to see the 50 basis point move to hold there. Talk to me, I ran through the issuance, obviously we had closure and then we'd reopen, but you say the demand was really pent up and the oversubscription on some of these issues was strong. Just talk me through how that looked.
Yeah, I mean, it was clear to me from the order book behavior this week that investors had been waiting for this, like I mentioned. We had oversubscription levels on Tuesday and Wednesday of this week that were near 6 to 7 times, where on average our market is more like 3 to 3.5 times. So a massive amount of interest plowing into our calendar. New issue concessions gapped ever so slightly wider on Tuesday as we were reopening the market, but we've come right back into sub 5 basis points. So think about that. The risk premium is under 5 basis points to access the market right now for investment grade capital. The pockets are really deep. I think investors, again, are looking at an opportunity to layer in at spreads they haven't seen really since late of 2023. And they feel like now is the time. And so, our market, again, priced $54 billion without much hiccup. $34 billion of that came on Wednesday of this week, our biggest day of the year, 17 different transactions. So, it certainly feels like investors were ready and prepared to put capital work when they saw the right entry point.
And Matt, this comes back to the point you talked about credit outperforming the other assets, having outperformed by 1 sigma relative to, let's say, Treasuries, VIX, and yen. That robustness in credit remains so long as there is not some huge hard landing. And is that what drives that appetite that Maureen has just referred to in terms of, get in now, pick this up, because it has been resilient and something really brutal has to happen to unseat this credit investment?
Yeah, so kind of 2 good questions there, I guess. The first is, we think the demand's going to remain strong. Part of that is $6 trillion in money market funds, and a lot of our clients that have really been parked in short-dated credit. So short-dated investment grade has been a core holding, not just for fixed income, but broad macro investors. And so if the Fed really is embarking, as we believe, on a series of cuts, we have 2, but the bias is probably 2 to 3 this year, and a sequence of cuts next year, we think clients do have a little bit of FOMO, fear of missing out on the duration rally. And so we do think clients are not fully positioned out the curve and out of cash. The second point I think you're alluding to is what really disrupts credit. I don't think it will be fund flows. The 2 things we really think structurally over the last 3 decades are either a hard landing, you need a recession, and that has to be codified, and we just don't see that in the data, both macro but also credit. The second is a systemic shock. And I think that's what's reassuring with the performance of lower rated credit in high yield and loans, the performance of financials. It wasn't pretty, but it wasn't ugly. And I think underlying this, that's the second question, right? Either is the economy hitting a hard landing, or is there something else that's going to break? And I think part of that's difficult this cycle because a lot of the areas people are concerned about with credit vulnerabilities are either in private markets or in non-mark-to-market assets.
Well, let's see whether that yen carry trade really has 3/4 undone itself. Team, thank you very much for joining me. That's Matt Mish over at UBS, Maureen O'Connor at Wells Fargo on the credit markets. Still ahead, the final spread, the week ahead. Traders waiting for the latest US CPI print. This is Real Yield on Bloomberg. I'm Manus, Cranny. This is Real Yield. Time for your final spread. This is what we got coming up on the week ahead. Monday, we're going to get the U.S. monthly budget statement. Tuesday, it is U.S. PPI prints, along with remarks from the Atlanta Fed President, Raphael Bostic. Plus, you're going to get retail earnings rolling in from Home Depot. Wednesday, it is about the CPI figures coming out. That is the all-important focus for the market. Thursday, you're going to get U.S. retail sales and jobless claims again. Big outsized response to yesterday's. Walmart earnings hit the tape finally on Friday. You get UMich Consumer Sentiment Survey and a little bit more Fed speak for you from Chicago Fed President Austin Goolsbee. For my final thought, this is a look ahead to the CPI numbers. Look for a bump on the core.